Hi, we're today talking about 5 Chinese stocks for 2020. And some of these stocks are massively undervalued right now. And I'm going to take a look at 5 of my favourites that have kind of been hurt quite a bit over the last year, 2 years. A lot of it to do with the Chinese slowing economy, and also we've had the trade war going on. And most of these stocks have been affected by that, even though a lot of their revenue does not really come from the US. So I'm going to look at 5 of my favourites, and I'm going to talk you through each of these stocks and what I think of each company going forward. So number 5 is a stock called Momo, which is a stock I actually did not know about until I actually started researching for this video and just getting a little bit more information about each company. And Momo is pretty much a dating platform which is currently at $36 and on a little bit of a discount. It has now expanded from just being a dating platform, which was the leading dating platform in China, to being now an entertainment platform. The stock itself is down 30% off its highs, and the really attractive thing right now is that it's at a P of 22, which is, when you look at the growth of this company that I'll just talk about in a second, 22p is a pretty decent P going forward. The Q3 sales increased 22%, but that's actually the reason why this stock's down. The stock's down because of the slowing revenue, because revenue used to be 51% in 2018. So I look at Momo and I'm starting to see some great value, some high growth, a decent balance sheet. It has a little bit of debt, but it has like 3 times to cash of its debt, which kind of looks like, it could pay it all off, or is it looking to go buy another company or something? But the balance sheet wasn't too bad either. So Momo at the moment looks like a great company that I'm going to do probably a little bit more research in, and I might eventually go buy. But like I said, I just need to do a little bit more research. But that's the one that I didn't really know about until making this video. So that was really interesting, checking Momo out. Number 4 is Baidu, which has always been known as the Google of China. And Baidu has been hurt quite a bit. It's down at $119. And this share price has nearly halved over like the last year, 2 years. So it's absolutely down massive. It's been hurt by a lot of revenue slowdown, and its EPS has been slowed down. It has been investing quite heavy to try and expand the company though. And it has made a good investment in IQI, which is a pretty much known as a Netflix of China. But its revenue has slowed down. Its EPS has slowed down. It's been hit by margins quite a bit, and it's still growing at a decent percent. It's still growing at like a 10% rate. But its investment in IQI is kind of like the really interesting one because, like I say, it's known as the Netflix of China, and that stock is listed on the stock market as well. I didn't put that one on the list just because I'm kind of covering it in Baidu, but that company's growing at 15% year over year, which is fantastic. And as well as that, it's also currently making quite a chunk of Baidu's revenue up right now. So Baidu's kind of an interesting play. I know a few people don't like Baidu because of, I think it's the management, I think it is, and the balance sheet. But personally, I've not really had a big, massive deep dive on Baidu. But it does kind of look a little bit interesting because of the stock price halving really over like the last course of the year, 2-year mark. Number 3 is Tencent, and I'm not going to lie, trying to cover everything that Tencent does really in like 2 minutes or 3 minutes, it's really hard to do because they are in a lot of industries and have a lot of income streams. Tencent is one of the companies that I really like, but I've just never invested in. But it's trading about $45. That's on a bit of a discount as well. Like I say, Tencent has multiple income streams. It is kind of like owning Facebook, Square, Activision, and Netflix all in one, which is kind of fantastic when you think about it. Its revenue is increasing 21% year over year, and it owns WeChat, which is pretty much everyone in China pretty much uses WeChat, and QQ. And also it is the equivalent of having Activision because it owns Epic Games, which obviously has one of the biggest gaming titles out there right now, which is Fortnite. I think they also own a share in League of Legends, and when you talk about the amount of gaming and competitive gaming that's going is fantastic. It also controls a lot of Chinese payment sector along with Alibaba. So Tencent is in a lot of income streams, and like I say, it's a video that I'd like to do a full video on Tencent because it's really hard to cover everything in kind of like a few minutes. But Tencent is a fantastic company that's growing at fantastic rates, and with all its multiple income streams, it like when the gaming industry slowed down for it earlier in the year, it still had all the other industries that were covering that kind of like slowdown because it had a lot of problems with game titles being banned. So Tencent is a fantastic company and one that I've not invested in, but I've always kind of like thought about investing in it. And I think because I've already got 2 Chinese companies that are going to be the next 2 Chinese companies, is kind of the whole reason why I've not really invested into Tencent. Number 2 is JD.com, which is I currently have shares in JD.com, and it was my largest Chinese position at one point. It is trading around about $34, which is still off its 52-week highs, but nevertheless, it has had a really decent rally in 2019. I think a few people were kind of realizing how sold off this really is. And JD.com really is the equivalent of Amazon of China. It's been hurt quite a bit because of the China trade war. It also had some allegations against the CEO, which have now all been dropped. And I think since then, that's also, helped it go up. And as well, the last 3 earnings have been absolutely fantastic. And they have come pretty much like after a week after people have slated the Chinese economy. And they've brought these earnings out, which have been fantastic. They've spent quite a lot of infrastructure. It has some fantastic warehouses. I think in the world, it's one of the biggest warehouse holding company, if that makes sense. But yeah, it's a lot in its infrastructure. It's really advanced in the warehouses. A lot of it is automated by robots, and that kind of cuts the cost down of having an actual workforce. Because of all the investments over the last kind of 3-4 years, now it's starting to pay off because the EPS is absolutely going crazy and the revenue is not too bad at all. And it's a company that's not kind of now easing out. Now it's expanded so much. Its next kind of task is to go and look at trying to invest into the UK and Europe. That's kind of where it wants to go next, which it wants to battle with Amazon. Last time Amazon went into China against JD.com, JD.com won the battle against Amazon, so it kind of says a lot of how good JD.com were, that they were able to keep Amazon out of China. And also, it's also backed by Tencent, so if you kind of wanted to have a little bit of kind of coverage in JD.com, yeah, I guess you could look at Tencent. This is what I talk about, Tencent pretty much is fantastic in all the things they own. And also, it's backed by Walmart as well, so JD.com is another fantastic company, and a really cheap company at $34 as well. And my last one, number 1, is Alibaba, which is also my biggest position of a Chinese stock that I own. Alibaba is a fantastic company, and it has had a decent run over the last couple of days, last couple of weeks. So it is a little bit more expensive now, but it was at the $180 range for a long time. It's now at $204. It is a company that's growing its e-commerce side by 50%, and it allows other sellers to kind of go on the platform and sell their products. They own many websites, Alibaba, AliExpress, plenty more than that, but their commerce growth is at 50%, which is fantastic. They own a 31% stake in Alipay, which currently takes about 90% of Chinese digital payments, along with Tencent's payment system. So they pretty much, them and Tencent kind of control the payment sector. Cloud growth is fantastic. The cloud growth in Alibaba is growing at 84%. And also it has a lot of investments in the entertainment industry as well. It also has a couple of brick and mortar stores and kind of other little things going off around the side. I think it also owns quite a big chunk in a Chinese company that's on the stock exchange called Bilibili, which is a little bit of a entertainment, a little bit of a Netflix kind of platform. So they own a bit of industry in that, and Bilibili was actually a stock that I used to own a few years ago. And you get all of this kind of growth for Alibaba with fantastic revenue growth, fantastic EPS growth, and all of it is at a P of 22, which is fantastic because you look at a stock like JD.com and their P is around about I think their forward P is about 30, I think their actual P is about 50. So when you look at Alibaba and look how diverse they are compared to JD.com, and you get all the kind of things that they're in, and the P is 22. It's a really, really cheap company at the moment. And, if I always said this about Alibaba, I believe that if Alibaba was on a US company and not a Chinese company, I think Alibaba was a $250 stock easy, potentially pushing a $300 stock going forward. And those are my 5 Chinese stocks for 2020. Like I said, I currently own 2 of them. I'm currently looking at maybe the other 3 as well. I'm probably tempted to have a bit of more of a deep dive into them. So if you want to see a deep dive into any of these stocks, just let me know, guys, and I'll probably make a video about them because they are 5 really fantastic companies. So if you could give the video a like, subscribe if you haven't, I'll see you in the next video.